For 8 decades, the official currency of the United States of America has dominated the transactions that make the world go round. But did the United States unintentionally trigger a domino effect that resulted in other nations abandoning the American dollar as the preferred global reserve currency when it weaponized the dollar against Russia earlier this year? Welcome back to another interesting episode. In today's video, we'll be showing you why the US dollar may be in danger. Do make sure to like, share, and comment below, as it also encourages us to produce more valuable content for you all. If you have a specific topic you'd like to learn, please leave us a comment below and we'll work on it for you. For starters, the popularity of the US dollar has been declining for about 20 years, roughly coinciding with the start of former President George W. Bush's war on terror, which included financial sanctions against some countries accused of harboring known terrorists. In a world where a large portion of business is conducted using the American dollar as the common currency, restricting or cutting off access to it can be a very persuasive tool. Financial sanctions are a bloodless weapon that can still cause a great deal of harm in the short term. However, if that financial weapon of mass destruction is used excessively, other countries may be scared into diversifying their financial holdings, which is something that both Russia and China are counting on as they work to persuade other nations to use their preferred currency. The possibility of restricting the sale of Russian oil and gas to nations that pay in Russian rubles was raised by Russian President Vladimir Putin. While Russia provides a small portion of Americans' fuel, the country accounts for roughly 40% of gas and 30% of oil in the European Union. China has been urging the rest of the world for a long time to abandon the dollar in favor of the yuan, but only about 3% of all transactions take place in this currency. But even if some countries start to worry, America hasn't yet cashed in all of its assets and credibility because only about 40% of transactions are conducted in dollars. Will the dollar lose its value, and will it change its name to penny? An unexpected global recession could happen for a variety of reasons. The most likely scenario is one where there's a dual threat of high debt and high inflation, in which case rising consumer prices force the Fed to sharply raise interest rates. A rate increase following the teaser period would behave like an adjustable rate mortgage because the majority of the country's debt is composed of short-term instruments. International creditors may dump the dollar, leading to the collapse of the dollar if the U.S. government is unable to make its interest payments. If the United States enters a deep recession or depression without bringing the rest of the world down with it, users may abandon the dollar. A large power such as China or a post-EU Germany could also introduce a commodity-based standard and monopolize the reserve currency sector. However, even under these conditions, it's not clear if the dollar would unquestionably crash. The end of the dollar is still a long way off. The only prerequisite for causing a collapse that appears plausible is the likelihood of higher inflation. Exporters from other countries like Japan and China do not want the dollar to weaken because the United States is such a crucial market. There is no proof that the rest of the world would permit the dollar to collapse and run the risk of contingent, even if the United States had to renegotiate or default on some of its debt obligations. After more than 80 years of dominance, there may be a chance that the United States will no longer be the world's reserve currency. Dollars make up about 60% of the $12.8 trillion in global currency reserves, giving the United States a significant advantage over other nations. That distinction, however, comes at a cost. Interest rates are lower because U.S. government debt backed by currency is particularly desirable. The fact that the United States can borrow money from other nations in its own currency suggests that if the value of the dollar falls, so will the debt. In order to avoid conversion fees, American companies can conduct international business in dollars. The U.S. can severely restrict central banks' access to dollars, which isolates and depletes their economies. This is crucial. When Russia invaded Ukraine in February, the U.S. used this weapon, blocking $630 billion in foreign exchange reserves and significantly weakening the ruble's value. As a result, the U.S. was able to punish Russia without involving its military in hostilities. The use of a weapon of mass destruction, even if it is an economic weapon, causes panic among the populace. However, great power also comes with great responsibility. Other countries diversify their investments away from the US dollar and into other currencies to prevent a repeat of Russia's fate. This situation might jeopardize the nation's role as a reserve currency. According to Bank of America strategist Michael Hardnett, weaponizing capital may lead to its debasement. He went on to say that the balkanization of global financial institutions is undermining America's role as the reserve currency. According to a recent Foreign Monetary Fund analysis, the dollar's share of global reserves has been declining for the past 2 decades, roughly coinciding with the start of the U.S. war on terror and counter-terror measures. Since then, the Chinese yuan has replaced the dollar as the primary reserve currency, with the remaining 3/4 of reserves being invested in the currencies of smaller nations. If the last 2 years have taught us anything, it is that nothing is impossible. The United States losing its obscene privileges, however, incredibly unlikely. To begin with, the alternatives aren't particularly appealing. Despite the fact that China has been actively promoting the yuan for years, it only represents about 3% of global trade as opposed to 40% of the dollar. The rest of the world is still interested in the United States. The U.S. has the biggest and most liquid stock market in the world, and foreign capital is flooding the nation. According to the United Nations Conference on Trade and Development, global foreign and direct investment flows increased by 77% to an estimated $1.65 trillion in 2021, while investment in the United States increased by 114% to $323 billion. We may not enjoy the second quarter, but we will be ready for it. The first quarter of 2022 came to an end this week after being extremely volatile, with major market indexes posting their worst performance in 2 years. Inflationary pressures, Russia's invasion of Ukraine, and the Federal Reserve's rate hiking policy were all exceptional challenges for investors. In the second quarter, those issues will persist. In contrast, the devil you know is frequently superior to the devil you don't. The upcoming quarter is predicted to have the biggest challenges, according to analysts, who also discuss how they intend to address them. Here's what they found out. Russia's invasion of Ukraine has stunned markets worldwide. The geopolitical turmoil has had an impact on energy markets, commodities, and even food poverty. As supply tightens and demand holds steady, the price of future agricultural contracts is skyrocketing. It is typically best to avoid investing in commodities like oil and energy because they have a history of being very volatile and responsive to breaking news. It's time to consider real assets as an inflation hedge because the United States is currently dealing with an inflation issue that hasn't been present in 40 years. Investments in commodities, real estate, land, equipment, and natural resources are among the necessary expenses for this. Investment in real estate is growing in popularity. We don't think there's anything more popular on the market right now. You can choose between single-family homes, multifamily homes, computer centers, and cold storage facilities. Looking for companies that benefit from inflationary increases when investing in the stock market, banks profit more as interest rates rise and spreads widen. Businesses with low capital requirements are also a good bet. The stock market is weird. Every time one guy sells, another one buys, and they both think they're smart. The soaring dollar raises risks for the Fed as it attempts to control inflation without causing the economy to enter a recession. The stronger dollar may, in the short term, increase businesses and consumers' purchasing power when it comes to imports, reducing inflationary pressures. However, a strong dollar can also hinder American exports and the conversion of foreign profits by American businesses, which would be a drag on economic expansion. Longer term, the currency's strength would contribute to further tightening financial conditions. At the same time, when the Fed is reducing its balance sheet and foreign investment in the United States market may be slowing to coincide with recovery in other parts of the world. In conclusion, investors may not currently be aware of the implications of continued U.S. dollar strength, which could implicate the outlook for the economy and markets. Investors should, in our opinion, rebalance their international exposure, particularly in equities, and keep an eye on real yield differentials for clues that the U.S. dollar is peaking. The U.S. dollar could reach its peak in the following 3 to 6 months, and a tailwind could emerge, boosting regional markets' recoveries. If you found this info helpful, please give a thumbs up and subscribe for more content like this, as it also encourages us to produce more valuable content for you all. If you have a specific topic you'd like to learn, please leave us a comment below, and we'll work on it for you. Until then.